So Sean Bill, give you a quick synopsis. Started in 1994 at the Chicago Board of Trade and Commodity Pits when it was open outcry. Moved over to the fixed income world in 1998. Did that through 2011. Then became a CIO of a pension fund. Did that for 10 years. Was named the CIO of Power 100 from the CIO magazine. Then I switched back over to the hedge fund about a year and a half ago, and I'm focused on private credit. And I've been an active angel investor since about 2014.
Excuse me, Stephen Burke. I'm with ARS Investment Partners out of New York. We're a $3 billion, depending on the day, asset manager, mainly in the public markets. And I did partner with 361 and the Queen City Angels on the Tuesday venture fund. I started in the business in 81. Interest rates were 20% back then. I tried to get a job in commercial real estate, so shows how much I know about the world. But I'm looking forward to our discussion today.
Michael Spade. As you heard, I'm from Germany. Met Mark 25 years ago. I was from a past investment banker. Started my career in private equity and learned a little bit not to do this with a bank. So to become a private equity company, was a bank owned private equity company. There is strictly to do something with a company, and I did not installed before to be investors for myself with friends. That's the first thing I do, and have done 6 times transaction income from good to better. I'm running it as a small private equity boutique at my own family offices in Germany, investing in a couple of European transactions, and building now the 361 that we're worldwide. I have a PhD in marketing and finance, and being a father of 2 girls, I was interested in doing some similar stuff than I knew. So my oldest daughter has gone to 361, or she liked that. And she liked to run the next tunnel when she was ready with her master in the summertime, and that she will join us. And hopefully she can learn a little bit out of the NAP gens, which are also with us here.
Thanks. I'm Safar Rashti. I run an early stage venture firm in Silicon Valley called Think Plus. We invest in seed and Series A in companies across a number of industries that we identify each year as the markets that we think would be growing in the next 5 to 10 years. Thematic this space. Before that, I was an angel investor. Before that, I worked on Wall Street as an analyst for about 10 years. It was the first analyst to look at the search market. Google was just becoming a larger company well before, of course, they were public, and before the industry called go to search for no industry. And there I was the first analyst to look at China's digital market in 2003. There was, already almost seriously. So those things made me a lot of connections, and I was able to make myself on Wall Street. In 2007, I decided that I would take the connections and insights and become a principal investor. And I started making my investments, 30 investments in early stage companies, 7 exits of public companies, and I started taking myself as a second. Once I said, what's happening? What's scary and exciting? I try to look at the very top level picture, I mean 30,000, 6,000 feet. And because I think it kind of permeates from that level down, everything that we do, whether with investors or shopkeepers or whatever. And as I look at the past, I would say 20 years, the trend that I see that is worrying is geopolitics and how the countries are moving to different camps. There was a period when we thought capitalism and liberalism had won, and that was the direction that the world is going to take. With encouraging signs on that. But what we have seen in the past 10 years, especially certainly the last 2 or 3 years, is that that is not necessarily the case. and I worry about the impact of that. Now the growth to happen to the largest countries in the world like China and India, as well as the emerging countries in Africa and elsewhere. I think that protectionism and populism, those are the biggest threats that we are facing today for growth of capitalism and growth of liberalism. We need to go together. We can't really have a functioning and growth-oriented economic model without liberalism. So let me stop there and just see what else.
So it's absolutely exciting. Establish what scarcities that we have. This is also what Rafa mentioned. Living in Europe, where we have quite more closer to us than others, so we have refugees along the route to Germany. So we have to integrate with the Ukrainian people. See this day by day, coming also from Syria and all these crisis regions. To integrate them, it's a huge and very hard kind of work we have to do. What scares me is that our political situation is not that it's getting a little bit more to getting more settled. It's not that we have this consensus-oriented type of politics, which are going more to the back or to the right side. Yes, it's a good example that we have the same trends also in Europe. Yes, Germany was every time described as one of the countries where we have consensus-oriented type of politics. This will change. Yes, we will not never see this over the next 5 years. So we are going in a different way, and this will cause also some instability in the way how we manage the law. On the other side, we are in the century where a lot of people are happening, and where we see that new kind of business will be created. Yeah, so in Europe, it's a little popular. We are lack of talents. We have not so many people who can do that much. But other regions like Africa and Middle East, they're doing, and I see there's a lot of opportunities we can use to collaborate and also do this for the beneficial of all. And so if we learn to collaborate with them, use their talents and bring technology and everything over, this is a huge and beneficial way to grow the worldwide economy and also the path of the development.
I agree with them on the global fragmentation. It's one of the three big issues that's a negative. If you did a Venn diagram of the US and China where we overlap, there would be only white space. We'd have no overlap there. If you did it on Democrats and Republicans sharing ideas, particularly with the forest, you get no overlap there either. And that's tough to move forward when we have big problems that need solving. So I think you have the global fragmentation is one issue. I think you have a reset of the cost of living that we're going to be adjusting to that happened very quickly with a 5% increase last year. And then you have another destabilization factor, which is the reindustrialization of the global economy due to the issues that Safra was raising. I think those are all negatives and positives. It just is where you're going to play in that to get the investment opportunities. But I think it's one of those situations where the change is going to be so great that you have to actually be ahead of the curve and looking at where things are going and being really thoughtful about where you can and cannot invest. And the governments are telling you where you can invest now in a different way than they have in the past. China, you're seeing that in the US with the CHIPS Act and other acts. So where we spend our money is going to be in a different place, I think, as investors than it's been in the past because of that.
So I would agree with all the geopolitical comments there. I do think the divisions are challenging. From an investment standpoint, I don't know if you have that chart that has kind of the 2022 summary, which I think is very, very challenging. It's going to be the concern is really kind of how central banks are going different directions in the world, right? So you have the U.S. Has raised interest rates at the most aggressive rate that we have seen in history, really. You have a massive shift up in the entire yield curve, across the entire yield curve, which we saw that did to some of the banks recently here. And,
Sean?
yeah, so that picture right there, that far right side on the left chart, really just, really haven't seen anything like that. So since 2008, 2009, we've been in a zero interest rate or a ZIRP environment, with quantitative easing. And, to have such a quick and sudden shift, I think it is challenging, and that's where the Fed got behind on the inflation outlook. If you go to the next chart, you kind of see the results on this. The chart on the left is a chart that is a scatter plot that shows the frequency in which both stocks and bond indexes have been lower at the same time in history, and there's about 5 times that's happened. It's very unusual. Typically, your bond portfolio would be a ballast to your equity or other growth-oriented risks that you're taking in the portfolio. And we see this year where that failed. And if you look on the right chart, it shows you that basically a traditional 60-40 plan, which is a good chunk of institutional assets. In fact, I would say it's probably more conservative than most institutional asset portfolios. Most portfolios, you think about an endowment like Yale, may have only 5% in fixed income or 6% in fixed income. Many pensions don't have more than 14 or 15% in fixed income, so they're more heavily slanted with growth. So this is probably your better case scenario, really. This is the worst performance for pension funds since 1937. So if you think about and Stephen's spoken about this over the last few days, of the unfunded liabilities of pensions, you as taxpayers are all on the hook for that. Those are in the state constitutions, most constitutions, that they are contracts that cannot be renegotiated. So I think we'll see, a significant increase in the tax burden for folks in these states like California and Illinois and others. And so I think that's the big one. And I think when you look at central banks, the U.S. is leading the way. You really can't compare it to Europe or the BOJ, which would be the other 2 majors in terms of the rate increases. And that's going to create a lot of turbulence and side effects in markets.
All right, you basically said what's here. All right, well, that sounds, let's talk about, maybe you want to go micro too. What are you excited about?
It's
Say short and long.
Yeah, so Ferris Bueller's Day Off, right? The license plate says nervous, on the car, and that's how I generally feel about the investment markets. Where I would be excited, I do think that innovation and productivity are probably going to have another leg out here. We just heard from the folks at Fuse with AI. I think that's a big advance. So I do think that that's probably one of the most positive areas. I do think that, there's once you get past the transition of initial shocks to the portfolios, having higher interest rates is a very strong positive. And we're actually getting paid, for being savers again, which, when financial repression, that was not happening. So I think that's where you'll see pretty significant flow into traditional fixed income and alternative private credit. And I think those are probably the most exciting areas. I'd say that's kind of a barbell. The far left, growth oriented through venture capital, and the far right, probably private credit. These areas that most excited about.
For us, the ARS, we're in the public markets, so the opportunities created by the venture community are creating opportunities for us that we enjoy. So we're very heavily invested in a lot of the chip companies and a lot of the arms merchants into what's going on with the CHIPS Act. So really what excites us about the investment portfolio from a micro perspective is the CHIPS and Science Act, the National Defense Authorization Act give you a clear 10-year path for how the government's going to be spending money. And you saw that, you saw the FT article yesterday that we've already added another $200 billion to spend on manufacturing in the U.S. We think that's a really exciting area, and the Midwest is going to be a big beneficiary of that. Unfortunately, that transition from China back to the U.S. is going to be inflationary. So you have to think about how you play your portfolio for a bit of a higher inflationary environment. But like those areas, chips, defense, healthcare are among the top areas we're looking at. And then obviously the tech and the cloud setup, it all plays into what we're doing. So keep doing the venture stuff so we can keep benefiting the both markets.
So what exactly is that we in Europe, I'm taking the European perspective to get a little bit more local, that Europe started to become the leaders in climate tech and all of them type of impact investments. We have a lot of things introduced on the IT stuff. So companies like Nokia and Ericsson has gone. Everything has been shifted over to the US, and now Europe is realizing that venture is also important, and investing heavily in a couple of further technologies. I would also Israel, because for Israel it's a hub for Europe to develop further things, and maybe you know or not, Israel is reducing at the moment roughly 50% of all invasions worldwide. This was in the last 3 years statistic, and they are not able to bring this in the markets. So they do this to a certain point, and they need something. And Europe is definitely the main point to do that. It's also realized from the European politics that biotechnology is becoming an important factor, and we go to Sheffield later this year to look what they do. In the UK, we have the BioNTech topic in Germany, which is helping us to do that, and this excites us that the awareness that we can do something in these areas is great. So as 361, we're supporting with a couple of impact investments. We have hydrogen investments. We have now green energy investments, which are not so popular here in the US. As the US, it's much more behind that one. Wind energy, solar energy, everything besides that one, and distribution of that. This is something where we also need AI stuff or something, but this is still to run the processes. The business model for itself, it's a different one where we use this type of technologies and develop these types of business models. And this is important from a venture perspective, that Europe see there is an opportunity and doing that.
So when I said that the crisis or what you said worries us is the same, I didn't mean it as a joke. I really mean it because every crisis is an opportunity. So if you look at what you outlined as the problems the world is facing, and you bring it down to what areas can be addressed to solve that. To me, it comes down to 3 areas. Transportation, if it's still a problem, if it's solved. Energy, healthcare. Now, food actually, I don't think is a problem. The problem is the logistics. So the last one would be categories would be logistics. So building these areas in a significant way would help the growth of not just US, but the world as well as helping us countries that are underdeveloped to develop in a way that they can then adopt more of the policy model. Because we've been losing that battle in China with something. China has shown that, well, you don't actually have to be the policy to grow. And you can actually give you money and help you grow our way. So we have to reverse that. That's an opportunity for us, for the West and the US in particular in the next, say, 50 years. So if you want to come down further from that, and to the micro levels, certainly technology is going to continue to be, to me, almost a linchpin of all of this transformation to a more stable world. And in particular, in helping finally to have productivity go up by expanding the use of technology, both among demographics and among other industries. I think one reason that we haven't had any productivity increase despite the adoption of technology, some game-changing technologies over the past 40 years, is because it's been applied to a few industries only. And this has been a big enigma for the economists. Why hasn't productivity gone up, even with the PC or with the mobile or internet or cloud revolution? And some people think it would be finally true with the large language models and ChatGPT. I don't think it will happen necessarily unless we expand the use of technology to all the limits. In fact, if you remember yesterday I made a comment that technology has never really taken the job. And that's the reason productivity has not gone up. Because productivity is basically the total output divided by how many hours we work. If we had fewer people working, productivity would be up. It really hasn't gone up. So not only we have to invest in technologies that are changing the way that we do things, we have to make sure that we expand it to all the industries. And that's what we look at in terms of investment opportunities as well.
One other area that I think is really interesting in the public markets, public markets have reset. We've had a couple of resets over the last couple of years, but there's significant opportunities to buy single-digit stocks that are single-digit multiple stocks in areas that are absolutely essential for what's going on. I'll give you 3 industries. The steel industry is, if you take the top 5 companies, their combined market cap is less than $70 billion. Now think of all the infrastructure bill that's going to go on with the Infrastructure Act and the Chips and Science Act. It's going to be massive, and you could buy the top 5 companies with less than $70 billion right now. You can buy the top 5 E&P companies who banks have stopped lending to and are really moved into a profitability mode instead of a growth mode for single-digit multiples. And you can buy some of the tech companies at very reasonable multiples now, again, where you haven't had that opportunity. So I think there are a number of really good opportunities throughout the capital structure that you can take advantage of. People are, I think, ignoring or too slow to see the opportunities that are right there in front.
Yeah, I would agree with that. I think like the oil and energy space is definitely locked out from the capital markets. It's been pretty interesting, and we were looking at some bank lines credits for our funds. One of the first questions we got from the banks was, do you have any loans outstanding to oil and gas? I'm like, wow, this is it's definitely interesting. And, we're seeing it also, I'm also kind of a proponent.
What would their rationale
So, let me name it, like First Republic, for example, would not make would not enter into a loan agreement with us from leverage on our funds if we had any oil and gas exposure. And I don't know what the reason was for that, to be honest, but they were very clear about it, that just that would be a disqualifier. So, I don't know, imagine that comes top down.
By committee, they move the areas that are going to get them this banking. No, I wasn't doing it. That's what any history.
That's the only thing by administration or wartime scenario where what do you got friendly hands?
The other way,
Not a bad thing.
they cut permitting. They delayed permitting, so it hasn't helped.
Well, they also reopen.
But the,
I think they finished it.
the time issue is. Right.
So I defer to Dave on that because he probably got more about it than I know about it, but
So I'm just curious, many of you, so get an example of this. You've seen this in the Middle East, but you're also seeing this with oil and gas. I might actually, if I actually stuff that I didn't know about, I may talk about this later, but there's a company called Carbon Engineering that's being backed by Occidental Petroleum, right? And they're doing carbon sequestration, right? And so how many of these big oil and gas companies are actually going to pursue and be leaders in both dealing with the carbon impact, but also maybe even in new technologies like forms of energy? And, is there opportunity, given their resources and their infrastructure, for them to actually become leaders and as opposed to just being in a story? And I'm kind of curious if you have any thoughts on that. Michael, you might speak because Europeans have a better model, it seems.
It's not only European. We had last time we have been working with a guy called Michael Billion. He's running a Canadian company named WordPress there, and they're doing the user exactly what you described, and they have these fields and doing working on those things which can be developed on carbonization and producing oil and gas. But in general, what we see is, and we have not really lack. When we have the September or October session, we know there was an oil and gas guy. It was an interesting discussion because he's December. He's discussion. Yeah, and He's right to say, hey, we will have more oil and gas consumption in the future time, but the proportion of alternative energies will be increasing as well. Yeah, so in total, the oil and gas industry will become really important to work on the right way to do this and use everything is also the important factor. That the majority of everything it's done on technology from the technology side. It will be done on the real benefits. In fact, what will happen is, and then we will see. Let's take an example: Saudi Aramco. They have earned last year 150 billion more than the year before, and this is a huge amount of money. Because the oil price has dropped dramatically up, and it's not the way that they are expecting to get out. And this will give them a certain power to do some further investments and to do something what they can do with this small money. So if you have the resources in hand and you can use them, this will also change something in the world. So we have not to neglect that we can do something out of that. Germany, on the weekend, we closed our last 3 nuclear energy power plants. So we are completely off of that. I mean, Finland open. Sweden as well. So we're going to go a different way to do that. Everybody blamed Germany in September. Oh, you're losing now your gas resources from Russia. When we have a look to the storage, the wind was not that strong as expected, but we are still 86%. And so we have much more gas stored than ever in years before, and we also depending on Russia. So it could be also a possible way to do this with alternative energies. There's no one way to do this in this way or that way. We have to get the right balance. I would never usually say the nuclear power it should be off. This is a discussion in Germany which is 20 years old. When you ask people today, who will say 60% agree that nuclear power is important. You have to invest in that. They say because it's a long-term investment, you can do that. But nevertheless, the consumption of energy in the world will be increased, and oil and gas plays a big role. And what you described, is that for true? We have to look at those times we are able to do that. That's
not very fast enough. I mean, I think if you think about it, $150 billion additional profit. What do you think could have happened if a tech company had that? Wouldn't they say, well, let's put $50 billion up at this in the new areas that can bag it? I don't know too much about some of these companies that we share and you are doing some, but this is an industry that's changing, and they are not changing with the times. They would give you IBMs that would be left behind, not Microsoft and Google's, who have to decide that gold is coming, so we have to do that, or not cloud is coming, so it's not sufficient to have enterprise software. So here, I totally agree, we need new sources, but for a long time, we are going to use the fossil-based energy, so we need to capture that carbon and be able to deal with it. There's no way that even if you electrify everything that we're using in the world, that we can actually have clean energy, because we need energy to produce those batteries at those costs. So I think they're behind, and that's actually an opportunity for windmills.
I think there are some, I think the energy companies have earned a bad name, and in the last couple of years have worked to improve it. And I do think companies like BP, Chevron are leading a lot of these clean energy transitions. You know, they don't get any credit for it. They get blamed for everything. They get blamed for now trying to be profitable. That's what they're getting criticized for now, instead of growing for growth's sake, which was a terrible business model that they had going. But if you look at their data and their science and their knowledge of energy, that's so essential. We're going to throw that away, which is really what we're trying to do right now by alienating them. So I think ideology and poor planning are the part playing for energy transition, not the oil companies. It's not having a plan to get to the transition that you need, and we're forcing a transition we're not being ready, and that we're not ready for. We have a whole grid system that has to be completely revamped. So you can create all the different sources of energy you want, but you can't get it where it needs to get to. what's the value? So I think the fossil fuel companies do play an important role, have to be brought into the discussion differently than being adversaries. It's like when we criticize the banks in a way where they deserved it, but look what happened this time. It actually helped save the system again. So we have to embrace corporations differently. We have to set them up with better standards and better models and better regulations. But they get criticized for not pumping oil on demand, but it takes a while to get the oil fields ready to ramp them up again. So they can't just do it when the Biden administration or the Trump administration wants them to. We have to have a plan for what we're doing. We don't have it. So that's going to be the problem. Our company in the late 70s was subcontractors to the Carter administration on the future finding needs and energy costs of the U.S. And I think what came out of that plan was right on red at 55 miles an hour was our energy plan. We did nothing really more than that. So that's what we're suffering from, years of neglect of having a plan. Yes.
Just want to add to that, like all the companies that are doing, which that they're doing, I think the stock price are doing a lot better than just the oil and gas company just pumping oil and gas. Because Total and Shell, they all are just like BP and Exxon.
I don't really have a lot to keep building this there. You started to say three things, and energy was one of them. Well, I guess I sort of drifted that question. It's narrowed down to. I'm buying a little bit of time for the lunch.
Curious, like, in terms of portfolios, if people, what their thoughts are on digital assets and whether they've hold a portion of their portfolios in digital assets, given all the craziness that's been happening in the last year. Well, hands up, you own Bitcoin. Okay, so 1, 2 people. Okay, 3.
But by the way, it's not a big hand.
So I do have a little bit on that. It's
Okay.
it is interesting. So the pension fund that I used to run, we were the first US pension fund to buy Bitcoin. We put the proposal in 2019, and it was at $90,000 a turn. It got done finally in 2021 at 18,000. I think that, it's actually with everything going on with central banks and what's happening with the inflation and the devaluing of the dollar, through the printing, through the quantitative easing, et cetera, which you can find in the European central banks and JP, of course, Japan really kicked it all off 30 years ago, 40 years ago. I do think that is a core position of like a 1 to 3% is a safety valve that people should consider. And we did push that in the pension world, and it is interesting that a lot of pensions are looking at this. They don't talk about it publicly, but I can tell you, CalSTRS, some of the other folks are in private chat groups and doing their research, doing their homework, and trying to figure it out. And this area is so out of favor right now that we just did a $5 million loan to a data center that is with the Exxon Mobil folks, the Raymond family out of Dallas. And we were able to get mid-teens on the interest rates on that. They put up 40 million at equity. We put up 5 with an option for another 5. And we've got probably 3x covered on the electrical assets in terms of the transformers and the voltage, et cetera. Banks don't want to touch it. Like, they will not go near it. So you can get warrants on the equity. And it's a really interesting play. And, a small portion of the portfolio, I think, makes sense.
Well, I think it's the same thing with oil and gas. It's got this at least top down and we come Washington. And you think what we're seeing with Gensler was widely thought of as a component in the MIT index
Classes on this, and I think people have been really surprised at kind of the way the SEC has approached this stuff. So I think it's top down in Washington. I think there's a lot of conversation about Operation Choke Point 2.0, trying to choke this out. Because if you lose the dollar as it loses its reserve currency status, I don't think happens anytime for the next 10 years, 15, 20 years. But if you did, that's a real big problem just go with.
I think it's going to be the reserve currency for the next 10 years, probably even longer. I do think the alliances that are being created around the geopolitical fragmentation will weaken the dollar's strength, but it'll knock it out. Autocratic governments can't be a reserve currency. Japan right now is probably not in a good position to use reserve currency, was the euro. So I think you'll see more, excuse me, alignments like Brazil, Lou was talking about with Brazil and China. You'll do more agreements to trade commodities in their own currencies, but it still comes back to the dollar eventually. So I'm not sure it's going to be as fast as everyone thinks. And I don't think inflation is going to be running away like it did in the past. I think we're getting close to the peak, which will take some of the luster off of and move away from the dollar. So if the US stops raising rates, Europe's going to continue. I think the dollar will be fine because of that. But I don't see a replacement yet. And I don't think you want to go into a basket of currencies where you can't trust half the people in currencies.
What do you think about sovereign digital currency?
I think there's a really interesting marriage that's going to happen over the next 5 years between central banks and the rest of the world, and how digital plays a role in the digital central bank coins, which will allow money to flow more easily. The BIS did an interesting report on this, and they have the central banks at the bottom, but there's different ways you can go on a wholesale or retail basis for crypto and currencies combined. And I think you'll see that there are areas, obviously in Africa and other areas, it makes all the sense in the world. In other countries, it makes less sense. So I think you have to look at them on a case basis.
Euro, I think it answered Stephen's comment on that. I give you an example where I believe you're right. I think everything twice it's true or not. When I was starting my first PhD, I was in the beginning of the markets. I was in Palo and visited the Apple Research Center, and there was a guy that I've done my first PhD study on telecoms and how the telecoms will develop. And I said, if you will ask people on that, I say they will tell you everything. Saying telecom, it's telecommunication by phone, on the fire, and everything. So at that time, the question was, can we fill the T3 pipe just with data? T3 pipe is 34 megabits. So there's nothing from today yet. And I said, no, we can't do that. So we're not doing that. 30 years later, we know that we need fiber optics and we have gigabytes. We're transporting gigabytes. And the same kind of reinvented will also happen with other industries. Telecom is a good example. Within a certain time of years, the industry has changed dramatically, and we have brought in other industries. The internet was first that, and then other industries have been followed. IT, everything is based on data communication. The same will happen also in the banking system. I'm not a believer in the old banking system with the old style of money. So when you're talking about digital assets, this is exactly what we are doing. At the moment, we have a little bit of mistrust to blockchain, because blockchain is every time represented by cryptocurrencies, and cryptocurrencies, it's for most of the people, they don't trust in that. But if you don't trust and if you work on that, digital assets, everything based on blockchain will become definitely an important factor for all of us. And I believe in 30 years, we will never discuss any kind of currencies, and the US dollar has possibly a very low impact on those ones. We will have a unique for it digital based kind of exchange of things we do, and not having the same scenario we're talking about today. It's the same like 1992 when we're talking about the equivalent to 3 pack just with data. We have.
The only thing I would add is just echo what was said about central bank digital currencies. I'm not a believer in the current cryptocurrency models, or even blockchain. I think there are some uses for it, but I think it's the hype. On the other hand, I think it's inevitable that we will have central bank digital currencies. It makes a ton of sense. It is doable. It just has to be implemented slowly and gradually. And we would make the availability of payment much wider among population. What I'm actually excited is the next phase, when there will be interoperability between different countries and different currencies. Once we have different currencies, it will be much more efficient to transfer money across borders than we have right now. So I think that's pretty good for type of population. So, thank you.
Come join our 361 firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.